Fascinating story coming up. It's China. China's always fascinating. It's slowing down. Everyone's worried. What, 7.2, 7.3% projected for 2014? I'd say that was absolutely fantastic. But how does one take advantage of it? In the studio with me from Prescient Investment Management is Liang, who is head of the suite of products that Prescient allows us to invest in China with. Liang, thanks very much for coming in. It is a fascinating story. Maybe we should start briefly with macro and talk about it. I mean, it is slowing down and there is a potential bubble in the property market, but on the other hand, the numbers that come out seem to be fairly decent to me.
Lindsay, you're absolutely right. I think there's a ridiculous fascination about Chinese growth, whether it's 7.3, 7.2 or 7.1. I think the bottom line is, over the long term, the previous fixed income driven investment cycle, the previous model of Chinese growth, which is export based on global consumers getting themselves far more and more into debt, is over. That previous model was a terrible model that was never sustainable. It would have blown up eventually, so it was a terrible, terrible idea. I think the new model that's coming through is more about the quality of growth. So if you look at the reform policies put in place by government, areas no longer get growth targets. Now they want to see how your people are doing, whether the pollution is better. It's a much rounded picture of what constitutes success instead of growth. So I would say don't even be surprised if China growth turns out to be 4% a decade from now. I think the crucial thing is that the quality of life to improve in China rather than a fictional growth number that is shooting the lights out.
Liang, I think you've partly answered the question that I wanted to ask you at a macroeconomic level as well, and it's centered on the reforms and the extent to which you think that those reforms are well focused and the policies are sharp enough to actually have a very positive impact for investors who want to play in the Chinese stock markets.
I think the reforms have been, in terms of the reform that they put out, it has been unbelievable. So it's based on a few things. One of the big things is that market play a crucial role. So they want to reduce the power of the state, reduce the power of the monopoly of the state on enterprises, make everyone more efficient and make it more market-based economy. And that includes financial liberalization. The second pillar of reform that people don't, perhaps you've heard about it, perhaps not, is of course the massive clampdown on corruption. They've always said in China, the biggest threat to China is not the slowdown of growth. The biggest threat to China is political instability brought about by this massive corruption that's occurring in China. With the new political president coming to power, he instituted one of the biggest corruption clampdown ever seen in China. They've removed a former Politburo member that's going to jail in some of the biggest investigations we've ever seen. It's been good and bad. It's been good in the sense that he's really clamped down. It's been kind of bad because now the people are aware of it. So he's trying to be transparent and say, look, we arrested all these people. Meanwhile, the people are sitting there thinking, geez, they've arrested, this was going on and we didn't even know about it. But in terms of what they're trying to do, the policies have been fantastic. The crucial thing for them is whether or not they can implement it over the next few years. And for the first 2 years in power, the new leadership certainly seems like they got the political will and they got the guts to do it.
Liang, if I can ask you a little bit more specific questions about the fund itself. I've heard you obviously talking about where the economy is sort of bending towards. If we look at it, consumerism is going to become a larger part of the China story as the economy evolves. And if you look at it, they're doing so many things correctly, educating the population, creating infrastructure. If you do all of those things, business will happen. And obviously with that comes a wealthier population. So how is the fund geared towards obviously the future in terms of consumerism around China? If you can just give us an indication on that side.
Absolutely. I think what people don't realize is that Chinese consumer discretionary stocks at the moment are trading at a PE of about 10. Now this compares to the PE of about 30 in Africa discretionary stocks. So people are willing to pay for the same billion consumers in Africa a PE of 30, where they speak probably 8 different languages split around 24 different countries with no common infrastructure system driving through that. As you mentioned, China is completely different. You've got a homogenous group of more or less 1 billion, over a billion consumers, homogenous, Han-speaking infrastructure that's already been built and continues to be built that can service that people in one group. So firstly, from a valuation perspective, there's a massive opportunity in China at the moment. Stocks that we bought, for example, Maotai, which was the #1 alcohol brand in China. It's based on ancient Chinese rice wine, 1,000 years of history. 2007, you would have paid a PE of 100 for. Today, you're paying a PE of close to 10. That's all you're paying for it. They got net margins of 40%. They got return on equity of close to 35%. And you look at earnings growth of 33% a year, which has been unbelievable.
I think it's fascinating, actually, Liang, to talk about what we were talking about earlier on, and the fact that the Chinese authorities, after a few dodgy years of giving too many watches out to different people, but that was part of the culture, and now going back to equality for everybody, and the whole, every single person in the population must benefit from the Chinese miracle, and the state-owned enterprises, CEOs and chairmen taking pay cuts recently. Contrast that with Jamie Dimon, for example. How easy is it, though, let's get onto the market side of things and your funds, how easy is it for you to invest in China? You see the Shanghai Composite, that's not representative of the whole Chinese economy.
So surprisingly, if you look at it, right, so we invest in something called the Shanghai and Shenzhen Stock Exchange. Combined, the stock exchange is over 2,600 stocks, of which 1,500 is as liquid as our top 40. And if you look at the Chinese stock market, it is far more representative of the economy than, let's say, the South African stock market. So we have things like BTI, Richmond, Naspers, who, let's be honest, is a Chinese internet stock. Where the Chinese stock market have a lot of construction companies, railway companies, banks, consumer discretionary companies, utilities. So the Chinese stock market is quite well positioned to take advantage of that.
Liang, if we just look at your balance fund and we look at the asset allocation there, you have a heavy bias towards equities. Maybe just talk to us about the kind of sectors that you're looking at and the kind of stocks that you're most excited about in China.
Absolutely. I think on the simplest level, everything in China is cheap at the moment. So as you mentioned, we have a 91% weighting to equities, and that sounds ridiculously high for a balanced fund or a flexible fund. The reason behind that is that when I ask myself, what else do I need to see to have a higher weighting equity, I really can't answer that. So if you look at China, it's trading at a 3-decade low valuation. So it's the cheapest you can get it in 3 decades. It's never been cheaper for you to get access to China. The reforms are all going in the right direction. Accounting standards have come up massively so. Since 2006, they're on global IFRS accounting standard. Sentiment is very, very, very negative in China. As a South African investor, when you invest in China, you have a fantastic diversification benefit. The hard currencies, they have a soft currency, they have massive trade surpluses, we have trade deficit. If you rank emerging markets based on any measure you want, the sad thing is South Africa always comes up to be one of the worst ones, and China comes up to be one of the strongest ones. So it provides a natural diversification hedge. Now, on top of all of that, what you're seeing is that the stock market in China, because it's capital controlled, you can only invest if you have a license, is 2% owned by foreigners. So if you look at places like USA, Japan, South Africa, where anything between 30 to 40% owned by foreigners. The MSCI is going to include China into their benchmark for the first time in 2015. It's going to be a slow process. There'll be a small little bit of free float and growing to full free float over a period of probably 5 to 10 years. But nevertheless, more and more scrutiny, more and more global investors will be interested in there.
We'll leave it there, actually, Liang. Thanks very much for coming in. Fascinating insight. We could have gone on for another hour. That's Liang Du, who is the head of Prescient Investment Management's suite of Chinese funds.